While the world focused on rate cuts, election cycles, and intraday volatility, the real event happened at a loading dock outside a bonded vault. Screens showed liquidity. The vault showed absence. On paper, the gold and silver markets appeared orderly. Tight spreads, functioning arbitrage, contracts clearing as designed. Paper claims continued to trade at scale, reinforcing the impression of depth. But beneath that surface, the physical metal was no longer moving as expected. Bars were delayed, allocations were revised, delivery schedules slipped quietly, then permanently. This was not a shock. It was a reveal. The system did not fail all at once. It behaved exactly as engineered under stress. Margin. Rules adjusted. Inventory definitions broadened. Force majeure clauses surfaced in footnotes long ignored. Each response preserved the appearance of control while draining the system of what ultimately mattered: deliverable metal. What followed was not a collapse driven by panic, but a sequence driven by compliance. Between paper claims and physical metal widened beyond reconciliation. What visibly broke was nothing that triggered alarms. Prices moved, contracts cleared, screens refreshed as expected. To the public, the gold and silver markets appeared disciplined. Tight ranges, orderly pullbacks, familiar commentary explaining every tick. Volatility elsewhere absorbed attention. That was the noise. What actually happened was quieter. Delivery behavior changed. Fewer participants elected to take metal. More rolled forward. The dock slowed while the screen stayed busy. This divergence was not framed as stress because nothing failed outright. It was framed as efficiency. The system appeared calm precisely because pressure was being deferred, not resolved. Price discipline held. Physical discipline weakened. The causal chain was mechanical. A. Elevated macro volatility increased demand for paper hedges rather than physical settlement. B. Arbitrage incentives shifted toward cash-settled exposure because sourcing physical metal introduced friction and delay. C. Liquidity concentrated in futures and OTC paper while physical flows thinned. D. Margin pressure encouraged rollover behavior, reinforcing the cycle. The analogy is a queue. As long as most participants stay in line, the system appears orderly. The moment too many step out and ask for service at once, the line stops moving. Early in this phase, the queue shortened artificially because fewer people asked for delivery, not because capacity increased. Institutions interpreted this as reduced demand, not constrained supply. That misread mattered. Liquidity was not expanding. It was being rerouted away from physical obligation. The screen rewarded compliance. The dock accumulated silence. The first adjustment was subtle. Incremental margin hikes. These were framed as risk management, but functionally, they discouraged delivery-sensitive positions. Next came soft limits, position guidance rather than halts, then revised incentives that favored cash efficiency over metal movement. Each step reduced immediate stress while increasing deferred exposure. This pattern has precedent. In 1980, silver rules changed to preserve market order, not metal access. In 2008, liquidity was maintained while settlement trust collapsed. In 2022, nickel trading resumed only after rule intervention clarified who would be protected. Here, no halt was required. Discipline was maintained by making delivery unattractive. Signals emerged off-screen. Dealer premiums widened slightly, then stopped being quoted consistently. Reported delivery times lengthened by weeks, not days. Inventory classifications became more important than totals, with eligible metal rising while registered stocks stagnated. Industrial users did not panic. They adjusted quietly. Longer lead times, alternative sourcing, higher tolerance for delay. These were not headlines. They were accommodations. Indications suggested the market was adapting. Mathematically, it was concentrating risk. The screen, what visibly broke, was inventory symmetry. Public reports still showed metal in the system. Vault totals appeared stable. Exchange dashboards refreshed without interruption. To the public, supply looked intact. What actually happened was internal. Metal stopped circulating. Bars remained listed, but fewer were available for allocation. Withdrawals accelerated, while deposits slowed. The dock did not empty, it hardened. What changed was not the number on the screen, but the willingness to part with what was behind it. This was not described as a shortage. It was described as a logistical pause, a scheduling issue, a temporary imbalance. The system avoided the language of stress because nothing had formally failed. Yet the behavior inside the vaults had already shifted from distribution to preservation. The chain here was administrative, not emotional. A. Rising paper demand increased claims on existing inventories without requiring immediate delivery. B. Vault operators began prioritizing counterparties with senior claims or strategic importance. C. Metal was reclassified, eligible instead of registered, allocated but not movable. D. Physical liquidity was removed without changing headline inventory figures. The analogy is a bottleneck. Water still exists behind the pipe, but flow depends on who controls the valve. As long as pressure is managed upstream, nothing appears wrong downstream. But capacity has already been constrained. Arbitrage incentives failed quietly. Traders could no longer assume that paper claims could be closed with physical sourcing on demand. Margin requirements reinforced caution. Institutions with exposure to delivery risk reduced activity or shifted to cash alternatives. The vault became a static balance sheet item rather than a functional conduit. The first escalation was prioritization. Then came conditional access. Metal could move, but only under revised terms. Next came documentation friction, additional confirmations, extended settlement windows, revised custody language. These were not emergency measures. They were policy refinements. Each one reduced immediate drawdown risk while increasing systemic dependency on trust. The pattern rhymes. In 2008, assets remained on balance sheets but could not be mobilized. In 2022, nickel existed, but not at the price or time required. Here, gold and silver remained in vaults, but not for general use. Force majeure was not declared. It was rehearsed quietly in legal language and operational drills. Signals sharpened. Delivery delays became asymmetric. Large players still received metal, smaller ones waited. Dealer premiums detached from futures pricing and began reflecting sourcing difficulty rather than spot moves. Inventory reports showed growth in categories that did not require delivery commitment. Industrial demand pressure increased, not through panic buying, but through advanced contracting. Longer horizons replaced spot dependence. That reduced immediate stress while increasing future concentration. Reported stability masked a directional change. The vaults were no longer neutral infrastructure. They were decision points. The screen still showed liquidity. The dock showed control. And control, once exercised, is rarely relinquished without compulsion. What visibly broke was correlation. Futures volumes increased, yet physical turnover declined. Open interest rose even as delivery requests fell. To the public, this looked like confidence, more participation, deeper liquidity, tighter pricing. What actually happened was substitution. Physical settlement was quietly replaced with synthetic exposure. Paper claims multiplied while the underlying pool stopped expanding. The screen suggested abundance. The dock reflected restraint. This divergence did not trigger alerts because no contract failed. Every obligation was met, by deferral, by rollover, by cash equivalence. The market did not seize. It adapted. And in adapting, it detached price from source. The failure unfolded step by step. A. Tightening physical availability raised the cost and uncertainty of sourcing metal. B. Arbitrage incentives shifted toward paper-only strategies, avoiding delivery friction. C. Liquidity concentrated in derivatives, draining participation from physical markets. D. Margin pressure forced weaker participants to abandon delivery-capable positions. The analogy is a vacuum. Liquidity was not destroyed. It was pulled out of the physical layer and compressed into paper instruments. From a distance, pressure looked stable. Inside the chamber, imbalance intensified. Arbitrage relies on convertibility. When paper can no longer be reliably exchanged for metal within predictable timeframes, the arbitrage loop weakens. Traders demand higher premiums or withdraw entirely. Market makers continue quoting prices, but with reduced conviction. Institutional exposure increases because clearing obligations remain, even as exit options narrow. The system keeps moving because it must, but it is now moving on fewer physical foundations. Margin hikes accelerated, not dramatically, incrementally. Each increased discouraged positions that required metal delivery. Then came intraday margin calls, increasing the cost of holding exposure through volatility. No halts were announced, none were needed. Next came rule clarifications. Delivery procedures were streamlined. Alternative settlement language was emphasized. These changes mirrored past responses. In 1980, silver trading continued under revised rules that limited demand. In 2022, nickel markets reopened only after price discovery was subordinated to stability. Here, stability meant continuity of paper trading, not enforcement of physical settlement. Force majeure remained hypothetical, but its probability was now mathematically implied by the shrinking overlap between claims and capacity. Signals became harder to ignore. Dealer premiums diverged sharply from futures prices, especially for smaller bars and coins. Refiners reported allocation delays. Inventory reports showed rising eligible metal that did not convert to registered supply. Industrial buyers adjusted again. Some accepted substitutes, others prepaid months in advance. What visibly broke was coordination. Pricing still functioned. Clearing still occurred. From the outside, the market looked intact. There were no emergency press releases, no public rescues, no volatility spikes demanding explanation. What actually happened was retreat. Institutions began acting defensively, not publicly but procedurally. Lease desks reduced activity, credit committees shortened tenors, counterparties stopped assuming continuity. The dock did not shut down, it became selective. This was not panic as the public understands it. It was institutional caution, quiet, synchronized, and undocumented. The system did not announce stress. It internalized it. The chain followed balance sheet logic. A. Growing divergence between paper claims and physical availability increased settlement uncertainty. B. Institutions reassessed counterparty risk tied to delivery obligations. C. Liquidity was removed preemptively through reduced lending, higher haircuts, and shortened settlement windows. D. Exposure concentrated among clearing members obligated to intermediate regardless of conditions. The analogy is a vacuum again, but localized. Each institution removed liquidity to protect itself, unintentionally increasing pressure on those who remained active. No single action caused failure. The aggregate effect made failure more likely. Arbitrage incentives collapsed further. Even profitable trades were avoided if they required physical follow-through. Margin requirements rose, not because volatility demanded it, but because trust no longer substituted for metal. Institutions did not need prices to move to feel risk. They needed assurances, and those assurances were no longer cheap. First came internal limits, then external confirmations. Metal leases required additional documentation. Settlement windows narrowed. What had been standard practice became conditional. Historically, this phase precedes visible crisis. In 2008, funding froze before prices collapsed. In 2022, nickel trading halted only after institutions had already withdrawn. ARP, the pattern repeats. Silence first, headlines later. Here, exchanges did not intervene immediately because nothing had technically failed. But rulebooks were reviewed. Contingency clauses resurfaced. Force majeure was discussed in legal departments, not trading floors. Each step preserved institutional solvency while increasing systemic fragility. Signals shifted from price to behavior. Dealer premiums became inconsistent, varying by counterparty rather than quantity. Delivery delays became conditional, possible for some, indefinite for others. Inventory reports continued to show metal present, but accessibility declined. Industrial demand pressure intensified quietly. Long-term contracts replaced spot reliance. Some buyers accepted higher costs for certainty, others reduced throughput. What visibly broke was neutrality. The market still functioned, but not uniformly. Prices printed, trades cleared, yet outcomes diverged depending on position size, counterparty status, and settlement expectations. To the public, this looked like normal stress management. What actually happened was a rewrite of obligation. Rules that had existed as contingencies moved to the foreground. Delivery was no longer assumed, it was conditional. Cash settlement was no longer exceptional, it was emphasized. The dock did not empty, it became optional. This was framed as resilience. In practice, it marked the point where paper continuity was prioritized over physical fulfillment. The chain here was institutional and explicit. A. Sustained delivery pressure increased the probability of settlement failure. B. Exchanges and clearing bodies activated discretionary clauses to preserve market function. C. Delivery definitions were broadened, timelines extended, and substitution mechanisms highlighted. D. Paper claims remained liquid, while physical claims became contingent. The analogy is a margin call on reality. Instead of demanding more collateral, the system reduced what collateral meant. By redefining fulfillment, it avoided default while acknowledging scarcity indirectly. Arbitrage incentives disappeared almost entirely. Even if price discrepancies existed, they could not be closed with guaranteed delivery. Margin pressure increased, asymmetrically penalizing those still attempting physical settlement. Institutional exposure shifted from price risk to credibility risk. The system chose continuity over convertibility. Rule changes replaced halts. This mirrored history. In 1980, silver trading continued under restrictions that neutralized demand. In 2022, nickel markets reopened only after rules protected system participants from losses tied to physical scarcity. Here, the progression was deliberate. Margin hikes, procedural friction, settlement flexibility, force majeure readiness. Each step reduced immediate failure probability while increasing long-term default risk. Force majeure was still not declared, but its logic was embedded. The market was now legally prepared to fail gracefully, meaning selectively. D. Real-world signals. Signals confirmed the shift. Dealer premiums detached completely from futures pricing, reflecting replacement cost rather than spot reference. Delivery delays became open-ended, described as subject to availability. Inventory categories expanded, but registered supply did not. Industrial users responded by bypassing exchanges where possible. Direct sourcing increased. Advance payment became common. These actions reduced visible demand while increasing off-market strain. Reported liquidity remained high. Physical confidence did not. The screen still offered prices. The dock offered conditions. And conditions, once introduced into a delivery, promise, signal that the promise itself is no longer universal. What visibly broke was closure. Not a shutdown, not a halt, but an ending to availability. Screens continued to quote prices. Contracts continued to trade. But physical metal stopped leaving the system in meaningful volume. The dock was operational in form, inert in function. To the public, nothing dramatic occurred. There was no declared shortage, no official default. What actually happened was terminal prioritization. Metal that remained inside vaults was effectively spoken for by sovereigns, by strategic counterparties, by obligations that predated the crisis. Everyone else was offered alternatives. This was the point where participation no longer implied access. The final chain was unavoidable. A. Sustained paper expansion exhausted the pool of unencumbered physical metal. B. Vault operators and custodians locked remaining inventory behind priority claims. C. New delivery requests could only be met through delay, substitution, or refusal. D. Default risk became embedded not as an event, but as a condition. The analogy is a queue at the end of supply. Early participants are served. Late arrivals are informed that service still exists, just not for them. The line does not collapse. It simply stops advancing. Arbitrage was no longer theoretical. It was impossible. No price differential could summon metal that was already committed. Margin pressure ceased to matter because the constraint was no longer financial. It was physical. Institutional exposure crystallized as reputational and legal risk rather than trading loss. The system reached its limit without breaching its rules. There were no further margin hikes, no halts, no emergency announcements. The escalation ladder ended, not with action, but with saturation. Historically, and this phase is recognized only in retrospect. In 2008, money markets froze before defaults were named. In 1980, silver obligations were neutralized through rule structure. In 2022, nickel losses were socialized through cancellation. Here, the outcome was quieter. Force majeure did not need to be declared broadly because selective non-performance achieved the same effect. Obligations were honored where necessary, deferred where possible, and avoided where permitted. Stress did not explode. It settled. Signals converged. Dealer inventories thinned visibly. Premiums became irrelevant because supply was unavailable at any price. Delivery estimates ceased to include dates. Inventory reports stabilized, not because inflows resumed, but because movement stopped. Industrial demand adjusted structurally. Some operations slowed, others redesigned inputs. The exchange price became a reference, not a procurement tool. The screen still showed liquidity, the dock showed finality, and finality, in a system built on continuous circulation, is indistinguishable from default, except that it arrives without sound.